Ever wondered why central banks make such a fuss about raising interest rates? It's all over the news, and suddenly everyone's talking about it like it's the hottest gossip in town. But why? What's the big deal? Central banks are like the wise elders of the financial world, keeping a watchful eye over our economy. Why mess with a delicate balance of interest rates in the first place? Let's break it down. Imagine you want to borrow some cash from a friend. They're cool with lending you the money, but they want a little something extra in return. It's like saying, sure, I'll lend you $50, but you gotta buy me lunch next week. That little extra you have to pay back? That's the interest rate. Now, when central banks start cranking up those interest rates, it's like they're tightening the screws on borrowing. Suddenly, it's not as easy or cheap to borrow money anymore. And you know what that means? The cost of borrowing goes up, which can put a damper on all sorts of things, from buying a new car to starting a business. But rising interest rates aren't just a slap on the wrist for borrowers. First off, consumer confidence can take a hit. When people start feeling uncertain about the economy, they tighten their purse strings and hold off on big purchases. And what happens when folks stop spending? Well, businesses start to feel the pinch too, which can lead to fewer jobs and lower wages. Rising interest rates can send investors running for the hills, causing stock prices to take a nosedive. Suddenly, everyone's scrambling to sell, but before you know it, we are knee-deep in a full-blown market downturn. But central banks aren't just raising interest rates for kicks and giggles. Nope, they've got a good reason behind it all: inflation. You see, when prices start creeping up faster than a vine in a rainforest, that's bad news for everyone. Suddenly, your paycheck doesn't stretch as far, and everyday essentials start costing an arm and a leg. So what's a central bank do? Well, they roll up their sleeves and get to work, raising interest rates to put the brakes on inflation. It's like trying to slow down a runaway train before it careens off the tracks. Sure, it might be a bumpy ride for a while, but in the end, it's all about keeping our economy chugging along smoothly. Now, naturally, you'd want the interest rate to be as low as possible, right? If you're the savvy saver type, you're probably keeping an eye on interest rates too. And when interest rates are high, that means you can earn more on your savings. Think of it as a reward for leaving your hard-earned cash sitting pretty in your account. Now, how big of a reward you get depends on a whole bunch of factors. See, there's no one-size-fits-all interest rate in the world of finance. Nope, you've got thousands of banks out there setting their own rates, each one doing its own thing. But all those rates are influenced by the big boss, the central bank. So what exactly does the central bank do anyway? Well, think of it as the ultimate banker's bank. Just like you've got your trusty savings account, commercial banks have their own stash of cash called reserves. First off, they can lend those reserves to each other, and you guessed it, they charge interest on those loans. But they can also park their excess reserves at the central bank and earn interest on them. Now, while us regular folk can't tap into those juicy interest rates on reserves, they still have a sneaky way of affecting us. Yep, even though we might not realize it, those rates set by the central bank have a ripple effect that reaches all the way down to our wallets. Whether it's the Fed in the US, the Bank of England across the pond, or the European Central Bank holding down the fort in the Eurozone, they've all got one mission: keep inflation in check. And their target? A cool 2% inflation rate. It's like trying to steer a ship through stormy waters. And interest rates are their trusty rudder, their go-to tool for keeping the economy on course. You see, when commercial banks start raking in the dough from those higher interest rates, they're not so keen on lending out their cash willy-nilly. Nope, they start hiking up their own interest rates for loans, mortgages, and what have you. It's like saying, if you want to borrow my cash, you better cough up a little extra in return. And that's where the rubber meets the road for us consumers. Take mortgages, for example. In places like Finland or Australia, where variable interest rates are the name of the game, higher central bank interest rates mean one thing: bigger bills. If your mortgage rate is tied to the central bank's rate, you could find yourself shelling out more dough each month, leaving less cash in your pocket for the fun stuff. When households have less spare cash in their pockets, what do? They tighten those purse strings, of course. It's like hitting pause on the spending spree and opting for a cozy night in instead of hitting the town. And when households spend less, businesses start taking notice. So what's the result? It's like a chain reaction that leads straight to the heart of inflation. Less spending means businesses are less inclined to hike up their prices, which in turn puts a damper on the whole inflation party. See, in countries like America or Canada, where fixed-rate mortgages reign supreme, folks might breathe a sigh of relief when central banks start playing the interest rate game. Sure, they're protected from the direct effects of those rate hikes, but guess what? They're not off the hook just yet. You see, even with a fixed-rate mortgage, higher interest rates mean bigger bills. And if that's the case for everyone jumping into the housing market, guess what happens next? Yep, you guessed it. House prices start taking a nosedive. Suddenly, homeowners are feeling a little less like kings in their castles, and a little more like paupers. And when folks start feeling the pinch, they're not exactly eager to open up their wallets and splurge on that fancy new gadget or dream vacation. But it's not just consumers feeling the squeeze. Oh no, businesses are in for a wild ride too. When interest rates start creeping up, it's like putting a hefty price tag on borrowing and investing. Suddenly, businesses are thinking twice about expanding operations or hiring new folks. It's like trying to drive with the emergency brake on. Things start slowing down real quick. And when businesses start pumping the brakes, guess who else feels the heat? That's right, us regular folks. With fewer jobs and lower wages floating around, it's like a double whammy for household budgets. Suddenly, that paycheck doesn't stretch as far, and folks are starting to feel a little less confident about splurging on those non-essentials. The age-old question, what's the deal with raising interest rates? Sure, it might seem like a simple solution to curb inflation, but it's not all sunshine and rainbows. There are risks involved, and navigating those choppy waters can be a real challenge. You see, the tricky part is figuring out just how far to go. Back in the wild days of 1981, the Federal Reserve in the USA decided to crank those interest rates up to a mind-boggling 19%. And while it did put the brakes on inflation, it also sent shockwaves rippling through the economy. Suddenly, folks were tightening their belts and businesses were feeling the pinch. It was like hitting a speed bump at full throttle. And before you knew it, we were knee-deep in the worst economic mess since the Great Depression. But getting inflation under control without putting the brakes on economic activity is like trying to juggle flaming torches while riding a unicycle. It's no easy feat. For example, it's been over 70 years since they managed to wrangle inflation down from over 5% without kicking off a full-blown recession. You see, high inflation means businesses have to shell out more dough for wages, which in turn drives up costs. And what happens when costs go up? Yep, you guessed it, prices follow suit. It's like a never-ending game of tag, with wages and prices chasing each other around in circles. Take India, for example. With retail inflation soaring to a whopping 7.8%, it's like trying to wrangle a wild elephant. You never know which way it's gonna go. And when you throw tepid economic activity into the mix, well, let's just say it's a recipe for some serious challenges ahead. So what's the bottom line? Raising interest rates may seem like a quick fix, but it's like pressing the brake pedal on a runaway train. It takes time to see results. In fact, it can take as long as 2 years for those interest rate changes to really kick in. You know, central banks have quite the crystal ball act going on. When they tinker with interest rates, they're not just shooting in the dark. They're trying to peer into the future like seasoned fortune tellers. You see, the real pickle is figuring out whether inflation is going to sort itself out or stick around for the long haul. While slowing down the economy might not be the most thrilling roller coaster ride, central bankers will tell you it's worth it in the long haul. So what's your take on this matter? Do let us know in the comments section. Also, don't forget to hit the like and subscribe button before you go. Until next time, see you all.